As of this exact moment, SoFi Technologies, ticker symbol SOFI, is trading live at $28.87, showing a robust intraday push of approximately 1.91% in the green. The market is open, the tape is moving, and we are seeing significant volume pouring in, with over 15.9 million shares already changing hands in just the first few hours of the session. If you are watching the charts right now, you are seeing a stock that opened at $28.71, dipped briefly to test liquidity at $28.31, and has since surged to tap a high of $28.97. The buyers are stepping in aggressively at every minor pullback, creating a classic higher-low structure on the minute-by-minute time frame. This isn't just a quiet drift upward. This is active, high-conviction accumulation occurring in real time. Now, looking at this price action, the immediate expectation, the narrative that has been drilled into every retail investor's head for the last 3 months, is that SoFi stock has run too far, too fast. We are talking about a stock that has rallied significantly, causing analysts to scream overbought and slap hold ratings on the name because the valuation multiples looked stretched compared to traditional banks. The consensus belief right now is that we are due for a cooling off period, a reversion to the mean where the stock takes a breather. That is the expectation. But the reality? The reality is that the market is fundamentally misunderstanding the velocity of SoFi's transition from a lending-heavy bank to a capital-light technology compounder. What we are seeing on the tape today isn't a blow-off top before a crash. It is the early stage of a repricing event where institutional capital is finally realizing that their models for this company are broken. They are valuing SoFi like a bank, but the internal data suggests it is trading like a high-margin enterprise software company. The overvaluation fear is the trap, and the underlying momentum is the truth you need to pay attention to. Let's actually pull apart this intraday movement, because the devil is in the details. When you look at the order flow today, you aren't seeing the sporadic, panicked buying of retail traders chasing a meme stock. You're seeing block trades, large, consistent purchase orders executing at the bid, providing a floor that refuses to break. This is characteristic of institutional accumulation, where big players like Fidelity Investments or funds managed by BlackRock are building positions without trying to spike the price too drastically. They want in, but they want in quietly. The Relative Strength Index, or RSI, on the hourly chart is hovering near overbought territory, which usually signals a sell, yet the price keeps grinding higher. When a stock ignores overbought signals and refuses to sell off, that is a sign of immense underlying strength. It essentially means the buying pressure is so intense that it is overriding standard technical indicators. The bears are trying to short this at $28.90, expecting a double top, but they are getting absorbed. Every time the price dips 10 or 15 cents, it snaps back up within minutes. This tells us that the bid is underneath the market, meaning there is a deep pool of buy orders waiting just below current prices to catch any falling shares. Now, pause for a second. I want you to think about your own portfolio. Are you holding SoFi right now, or are you waiting on the sidelines for a dip that might not come? Comment below how many shares of SoFi stock you currently hold, or if you are planning to enter a position this week. I want to see where the sentiment is among serious investors. The reason this price action is so critical is that it defies the hold ratings we have seen recently. Analysts from major firms have been cautious, citing that the stock price target of $26.61 has already been surpassed. They are looking at trailing 12-month earnings and saying it's too expensive. But markets are forward-looking mechanisms. The market is pricing in the next 12 months, not the last. And the next 12 months for SoFi look drastically different because of the profit loop that has finally clicked into place. This is where the tension lies. You have a skeptical analyst community looking at historical data, and you have a voracious market looking at future cash flow compounding. To understand why the market is bidding this up, we have to look at the structural change in the business. Most people still think of SoFi as the place to refinance student loans or get a personal loan. That is the expectation. It's a lender. But the reality? The reality is that the lending business is becoming just the fuel for the real engine, the technology platform and the financial services segment. When you use SoFi Invest or their banking products, you aren't just a customer, you are a data point in a closed ecosystem. Let's break down the business model properly because without this, the stock price makes no sense. SoFi operates in three core segments: lending, the technology platform, which includes Galileo and Technisys, and the financial services segment. The lending segment is the legacy breadwinner: personal loans, student loans, and home loans. It brings in the cash. But the real story is the technology platform. Think of this as the AWS of Fintech. They own Galileo, which is the back-end infrastructure that powers other fintech companies. When you use a debit card from a competitor, or perhaps a Robinhood cash management account, or even services from interactive brokers trading platforms, there is a chance the transaction is running on rails that SoFi owns or competes with. They are selling the picks and shovels during a gold rush. Then they bought Technisys, a cloud-native core banking platform. This allows SoFi to move its own banking stack in-house, saving them massive amounts of money, estimated to be $75 to $85 million in cumulative savings, while simultaneously selling that same stack to other banks who are desperate to modernize. This is why the comparison to traditional banks fails. A traditional bank like Wells Fargo or even a Fidelity brokerage operation has massive overhead with physical branches and legacy mainframe systems from the 1980s. SoFi is built on a modern cloud-native stack. Their cost to serve a new customer is a fraction of what it costs a legacy bank. When they add a new member, the incremental margin is huge. This is the financial services productivity loop they talk about. They lure you in with a high-yield savings account, then they cross-sell you SoFi Invest for your online investment needs. Then they offer you a credit card and maybe down the line, a mortgage. Each additional product costs them almost nothing to add to your profile, but doubles the lifetime value of you as a customer. This brings us to the recent Q3 2025 earnings, which were nothing short of a blowout, yet the market is still digesting the implications. SoFi reported record adjusted net revenue of $950 million, up 38% year over year. That is massive growth for a company of this scale. But the number that really matters is the adjusted EBITDA, which hit a record $277 million, up 49%. Margins are expanding. They're getting more profitable as they get bigger. That completely contradicts the bearish thesis that fintechs can't make money. They added over 900,000 new members in the quarter, bringing the total to 12.6 million. That is 12.6 million people who are potentially moving their direct deposits, their Schwab Intelligent Portfolios, their Fidelity IRAs, and their Robinhood stock trading accounts over to SoFi. The financial services segment, which used to be a cash burn pit, is now generating significant profit. Revenue in this segment grew 76% year over year to $419.6 million. This is the reality check for the bears. The part of the business that was supposed to lose money is now growing faster than anything else. And let's not forget the lending side. Despite high interest rates, they originated $3.4 billion in loans on behalf of third parties. This is a key pivot. Instead of holding all these loans on their own balance sheet and taking on credit risk, they are originating them and selling them to partners. This capital-light approach allows them to keep growing revenue without blowing up their risk profile. It's a genius move in a volatile economic environment. Speaking of the economic environment, let's look at the macro picture. We are late in 2025. Interest rates have stabilized but remain relatively high compared to the zero-rate era. Usually this crushes lenders because the cost of funds goes up. But SoFi has a secret weapon: It's deposit base. Because they have a banking charter, they can use their own customer deposits to fund their loans. They're paying 4 to 5% to customers, which sounds high, but it's cheaper than borrowing from the wholesale markets at 6 to 7%. This gives them a structural advantage over non-bank fintechs like Upstart or Affirm, who have to rely on expensive capital markets funding. When you compare SoFi stocks to SoFi ETFs or broader financial indices, you see this divergence. The market is starting to reward companies that control their own funding. Furthermore, the technology platform segment, Galileo and Technisys, posted net revenue of $114.6 million. While the account growth here was slightly flat, the revenue per account is going up because they are signing bigger, more established clients. They just announced a partnership with Southwest Airlines to launch a rewards debit